Welcome everybody to the Pieverse. My name's Perry. I will be hosting you tonight, and I just think we're gonna have an interesting video here. This video has basically been inspired because of the last market day major downturn that happened, or the major decline, thanks to a Trump-inspired market drop. Call it a manipulation or whatever it was, but at the end of the day, we have to deal with it one way or another. So I wanted to do this video because I know a lot of people follow me, as well as everyone else, but they follow me and are subscribed to me. A lot of you guys are newer DIY investors, and you might have been quite nervous about what actually happened. So I wanted to actually do this video to give you my perspective on it, especially with the regards to passive income investing. I know there's been a lot of, let's say, naysayers on passive income investing on covered call ETFs, and they always keep telling you, wait till the markets crash, wait till the markets crash. So anyways, what I wanted to do is basically give you this video to show you, okay, the market did crash on Friday, and how do I respond to it? And what I want to give you some perspectives on this scenario, because this is something that's going to happen time and time again, because that's what stock markets do. So this is basically during market chaos days, passive income comms. And the basic I got in this title here is that market dip bargains and how you actually can buy into them. So, all right. So again, here I am, Perry. Welcome again. So what I want to do is talk about briefly the what happened and how I basically responded to it. So, as we said on Friday, this was recorded on a Sunday, and 2 days earlier, the markets closed when Trump basically did a tweet, and which majorly triggered what was going to be a potential escalation of the tariff wars, which brought the markets down. I believe the S&P went down around 3%, and the NASDAQ went down around 4%. Usually the NASDAQ will go wilder because it's a more volatile index. So anyways, it went down. For me, directly related to the drop, my portfolio's NAV dropped 68K, as you can see in the title here. And again, I want to clarify things. When it dropped, I didn't lose 68K. So let's get it straight. Basically, an unrealized loss or NAV decline of 68K happened. In 1 day. So, and we're going to talk about this and put it into a broader perspective, but in a 1 day, it dropped 68K. But I also want to point out that during that same time, during all of last week, I received over 20K of passive income that came back into my cash balance, as all my covered call ETFs were paying out from Monday all the way through Friday. Friday was the biggest one. So I want to point that out because this is almost like a wave. Sure, even though that NAV declines, passive income is coming in. Why that's important is that the title I have here. So market dips for a passive income investor is the day of bargains. And so you can use your passive income cash that's coming in and basically is refilling your cash balance bucket every day or every week, depending on the cycle of what passive or what covered call ETFs you have, to go and buy those deals. And I'm going to point out later on why this is different than any other kind of portfolio. A passive income portfolio uniquely can take advantage of this. And that's why if you're a passive income new investor, you need to really calm down and say, look, this is not a bad thing. This actually could be a potential good thing to make your portfolio grow even further and actually be more resilient. So, all right. So what I'm going to do is I'm just going to go through my Snowball Analytics and show you what actually happened with my portfolio. And then just talk about what I actually did as a result of the decline on Friday. So what we're going to do is I'm going to switch over to my browser first. So this is my Snowball Analytics for my portfolio. I'm going to make it as big as I can, so hopefully you guys can read it. So what this is basically is my main screen, And you can see my current value is 1.664 million. My total invested is 1.887. That's how much I've invested in it. But the important number to see right here is this number right here. Sorry, you can see my portfolio dropped $68,520 on Friday, or a percentage of almost 4%, so 3.95. That sounds like a big number. Well, obviously it is a big number, but there's two things. One, as I said before, this is nothing more than unrealized loss. So it dropped 3.95% in NAV decline, unrealized NAV decline. Another thing is it's that you need to keep in mind. This is, because I've had a lot of the trolls and the growth purists that turn around and say, well, just wait till the first major market drop happens and stuff. And we've had market drops, and this has happened time and time again. So they said it's gonna decline because you bought all these cover call ETFs. They're going to be overly sensitive to things, and they will drop way further than the markets will. Well, it didn't. So just to give you a perspective, I have a portfolio, and you can see my passive income is running around a 40% yield. So that's pretty aggressive. I have what's called a growth income portfolio. So I do invest in not only the more conservative cover call ETFs, but I also invest in some of the more aggressive extreme or ultra yielders. All of them are actually, a lot of them that are related to the NASDAQ or related to even a higher volatility ones than the NASDAQ. So it's not shocking to see that my NAV declined 3.95% and the NASDAQ declined almost the same amount. All right. So the reason I'm pointing that out is it makes sense that mine would decline to the NASDAQ, because the NASDAQ is also the more volatile high-tech stocks. Those are the ones where a lot of the cover call ETFs are investing in. And so my portfolio would really align closer to the NASDAQ's movements than the S&P's movements. And therefore, not shocking again that my portfolio declined in NAV by the same amount that pretty much the NASDAQ did. All right. So I wanted to point that out. The other thing is, it shows here that I'm down $68,000. So let's put it in perspective that, yeah, it went down $68,000. And again, for any of you that have portfolios relatively similar to mine, a lot of passive income investors do. They're investing in a lot of the same covered calls. I want to put in perspective what that meant over the entire, let's say even the last month. So I'm going to go over here under growth. Okay, so this is growth, and I'm just trying to show here. So you could see, obviously if I go to the past 7 days, I can't go to the last day, but if you go to the past 7 days, yeah, okay, you can see definitely that my portfolio declined on the Friday. Here it is right here. It was here, and then it dropped down to here. By the way, if anyone says, well, Perry, I thought you said your portfolio is 1.7 or 1.6 something, and here it's only showing it's 1.52. The reason is that Snowball does not include my cash holdings, and currently I'm holding a lot of cash because of my Athabasca swing out trades. So I'm sitting on a lot of cash waiting for it to go back in. Turns out that might be actually an absolutely great thing, and we'll talk about opportunities later. But that's why, for those people who are wondering why is it not showing 1.66 or 1.65 or whatever it is, it's because these charts do not show cash holdings. It only shows invested assets. But so that being said, my invested assets went from 1.577 down to 1.52. There's sort of that thing. But if you could also take a look here, that's just for 1 day. So that was a big drop, but let's even just go and say, let's look for the last month. So here's it in the last month. And you could see that in the last month, basically, it just brought it back down to about where I was before. And by the way, just in case you're knowing, the S&P is the orange line and the blue line is my line. So over the last month, I've been generally outperforming the S&P. You can see here that we were neck and neck for the entire month. And then I started actually outperforming the S&P. And you can see on this day is where we both dropped down. So we both dropped down. But if you look here, I'm higher today than I was back a month ago when I was at 1.49, and here I'm at 1.52. So in the grand scheme of things, this drop that happened on Friday brought me not even down to the beginning of the month. But if you actually take a look at the difference of 3 months, you can see that nothing's really changed here either. I'm actually, after 3 months, I'm at 1.5, and over here I'm at 1.52. So I'm almost not changed even after 3 months. And if I look under 6 months, I'm just giving you here. So here's after 6 months. This was back in April, and I was at 1.23. And this is, again, taking out my cash holding. I was at 1.23, and here I'm now up at 1.521. So was it a decline? You can see the decline. It dropped. But think about how much you have made over the past 6 months, 5 months, everybody. If you've been invested in the markets over the past 6 months, you've gained way more than you lost on Friday. So that's the other thing you should keep in mind. So you have to expect corrections are going to happen. And I'm going to tell you, I'm no crystal ball person. I wouldn't be shocked if on Monday the markets are going to go down even further. There's going to likely be a lot of turmoil as China will respond to Trump's threats on tariffs, and so don't be surprised if we see the markets go lower. And again, before something happens that will maybe stabilize it again. So be ready for that. But keep in mind that the markets do go up and down, and you just got to know if your portfolio can tolerate it. So again, my NAV declined, but here's the one thing that will not change much. So even though it declined, I'm going to go over here, go over to my, I have to go to my, my calendar. I'm going to go to my portfolio calendar. So over the last week, while my NAV declined by $68,000, I collected over $20,000 in this week alone in cash. So over from Monday all the way to Friday, my cash balance, which was already larger anyways, I was sitting on the thing because of Athabasca. But even if I didn't, even if I had zero money in my bank, in my cash balance on Monday, by Friday, I had $20,000 in my cash balance. And why is that important? Because as a passive income investor, something that a growth investor or a growth portfolio cannot do unless they actually have to contribute externally from external sources, like from their job, and they're like, oh, I'm going to have to put this money in. Or if they were sitting on some form of a cash wedge where they was sitting on idle cash that they basically capitalized from something else, and it was just sitting there waiting for this deal. Then the benefit of a passive income portfolio like the ones that we are living on right now is the fact that I don't have to go and look for contributions, and I don't even have to look for idle cash sitting there generating no income or no capital appreciation. Every week I'm getting new money. And why is that important? Because with Friday's NAV drop of almost 3 to 4%, guess what you could do with that passive income, that cash that came into your balance? You can start going for bargain hunting and start looking for deals. You know that you're going to constantly be reinvesting anyways. So when the markets are really high, it's hard to find something that you want to invest more or reinvest more into, because you know the markets are near the top. We're at all-time highs. So you're a little bit nervous on buying, say, NVIDIA or PLTY. Pick any of these. Say you need to top up on WPay or whatever, and you're saying, oh yeah, but it's already, HOW, for example, it's already at near all-time highs. Do I want to buy another 10 shares of this? But when you see a market correction like this, it's almost like a little gift in the fact that the market's actually dropped 3 or 4%. Because now you can say, okay, I feel much better buying this dip, because you pretty much know that there's a good chance it will come back. And a lot of times with these geopolitical volatility ones, which I almost, again, in my personal opinion, think it's almost market manipulation, like it did happen in March, April when the liberation tariffs were announced. Those markets rebounded really quickly. So you can actually take advantage of some of those short-term drops that are happening and buy into them. And that's why is a real benefit of passive income investing is that you don't have to bring in external contributions from your employment income, or you don't have to sit on idle cash waiting for that next market correction that could maybe be tomorrow, or if you're sitting on it, it might be not for another 2 months, 3 months. I mean, this has been the first major market correction since the spring. So can you imagine if you were a growth investor and you were sitting on idle cash waiting for that major correction to happen again, and you had to wait 6 months or 5 months for that to happen? That's 5 months that though that money was sitting idle, not generating either capital appreciation on their behalf, or on our part, it would be money sitting there not generating income. So that is one of the major advantages of a passive income portfolio versus a growth income portfolio at times like market corrections. Contrary to what people think, that think, oh, you know, when we have a market correction, we're going to be in big trouble. The passive income is going to crash. No, it came back. And again, I want to go back to here because a lot of people say, yeah, well, you know, when the markets crash, they'll go down and you'll never recover. Well, excuse me, I did recover. Let's see if I can find it. There's your market. There's what my portfolio was doing along with the S&P. And right about here was the big market collapse here when we did the tariff announcements and stuff. And you can see, absolutely, I went down with the S&P like anybody else would, but it did recover, and I more than recovered. I was up here, and if you look at this is lower than this. So for anybody that says that passive income portfolios do not recover, well, I don't know, unless they're looking at a different planet or a different set of fake numbers. This is actual results right here. This is me at the correction, and this is my portfolio NAV after the correction. It did recover. So you know full well that this little hiccup here, even if it were to be another major decline of another 5%, all that means for me is it gets me even better deals, because guess what's going to happen next week that doesn't happen on a growth portfolio? Even on their growth portfolio, if they went and did some bargain hunting and they had some extra idle cash and they spent it and bought some more, I don't know, Nvidia or CN or Royal Bank, it's now depleted. So unless they can find extra contributions, which would mean from employment income or something, they have no more money to do any more bargain hunting. In a passive income portfolio, next week, I get another 10 to 15K of my portfolio will be coming in income. So it's going to happen again and again and again. So I'm always ready for another major drop, because this is what happens. This was this week. Next week, I'll get all this. Next week, I'll get all this. This is incoming capitalized income that I can either hold and wait or reinvest or whatever I want to do, but I don't have to look for contributions to actually buy into deals, unlike the growth portfolio, which actually has to have money either sitting idle or has to come from external sources. I have no money coming from external sources, and I don't have to have money sitting idle, because even if I decide to reinvest all this money and there was no correction, and then the correction happens, say Monday, well, I'll be able to use some money that's coming in here to actually buy that. So that's why, as a passive income investor, you really don't have to worry about market corrections. That's why the word passive is in passive income investing, because there's no having to do market timings and stuff. You know what? You just basically say, you know what? If I don't want to buy deals, I don't have to. If the markets collapse really low, I can buy some deals. And so that's why you really, as a passive income investor, I went to sleep on Friday night, not losing a minute of sleep related to the markets. I was actually happy. So what did I do when the markets collapsed on Friday or dropped on Friday? So I had that money already sitting idle, as you already seen, or, you know, money that was built up over the last week, over 20K. And I thought, okay, I was going to sit on it. But now that Friday showed up and we saw some deals, I decided I was going to do some buying. So what I did, I'm just going to go over here. I bought these three. So I ended up buying, how many? I don't even see where it says. I bought 30 of HOOW from Roundhill. And I'm telling you, the reason I bought Roundhill is because, HOOW is because if you look, going to the thing is, okay, so if you're bargain hunting, Perry, what are you bargain hunting for? Well, what I looked in the markets, I said, okay, well, which ones are going down the most? Like, sure, they're all going down. And matter of fact, I'm just going to call up my holdings. Holdings right here. I can give you an idea. So these are all my holdings. And to me, when I'm reinvesting, typically 90% of the time, I'm looking at bulking up ETFs that I already have. So I'm not looking for any new ones unless there was one on the sideline that I was looking to actually do it. But generally, no. Generally, I'm bulking up and adding more units to existing ETFs. So what I'm looking at here is I said, okay, so I went through here and I said, okay, show me. This was the daily loss for Fridays. You say, oh, okay, so AMSI went down 4%. Well, that's not bad. Here's Athabasca, which is one of my darling child. It went down 6%. So it's on my radar actually for Monday if the markets go down even further. I thought I missed the boat when it was over 717 this week because it actually went all the way up to 717. But on Friday, it dropped huge. It dropped down to 660. If it drops on Monday again to maybe 650, I think I'm going to move a lot of the money that I swung out of back in and sort of correct a little bit of my mistake because I know it's only a matter of time. In my own personal opinion, I believe it's going to go back up to 7 sometime soon. So I want to put some of that money that I pulled out, on that swing and put it back in and stay in at 650, 660. So that's likely what I'm going to do maybe on Monday. We'll see how the markets open and how the oil sector moves. But what else was available? Well, this one here was down 7.5%. So we're looking at bargain hunting, right? Well, here's a bargain hunting, 7.5%. So what I do is first of all, okay, well, AVG is interesting. Is it something that I need? So I had to go look into my spreadsheet. And when I looked at my spreadsheet, and I'm going to show you over here my spreadsheet. So I'm going to look at AVG right here. You can see here, I apologize if it's too small, but I'm going to go to my holding weights. And I'm just going to go over here. And you can see that AVG has a target of 2.5. And I could have actually brought that up I could have bought some of AVG. So that was one definitely that I could have actually increased in because it says my target weight was 2.5 and I'm only holding 1.2. So that definitely was a target that I did, that I could have looked at. And let me go back. But another one that was more interesting for me, and I'm going to go over here, was HOOW. So all the Robinhoods, if it was HOOY, HOOW, anything that was Robinhood related really went down low. So as much as I should have bought AVG, I wanted to actually bite in a little bit more in HOOW because it went down 10.2%. So I decided to buy 30 units of HOOW because I thought, okay, that's pretty good. So I did that. Again, my holding weight was a little overweight, but on the account that I bought it on, I had no HOOW. So I bought into that account just so that I had a position of HOOW in that account. The other one that I looked at buying when I went through it was WPay. It's only down 5.72% compared to some of the others that went down a lot more. Like, for example, TQQY was down more. But I was underweight in WPay, and I really like WPay because it's an all-in-one cover call ETF. So I decided I was going to buy a little bit more of that one. I think I bought 150 units of it. But anyways, I bought some of that one because the reason I did it is because even though my portfolio said I was around the target weight, I had zero position of WPay in one of my accounts. So I generally would like to have every one of my accounts hold a position in each of my ETFs. This one didn't have it. So I bought a position in WPay because that one account did not have WPay. So I bought that. It was a good deal, down 5.72. I don't know where its current price. Its current price is 73 Canadian. I think it was around 52. So it looked like it was a good price. And that's why I bought it at that thing. Okay. And then the last one I bought was another one where I had zero position in it in another one of my accounts. It was YSPY. I liked YSPY because it's one of my only holdings that has the S&P or is based on the S&P. So what I did is I decided to put this one in here. It's one of the few I have that have it. So it was down 6%. So I decided I was going to buy some of that one and fill up the position in an account that didn't hold YSPY. And that's what I did for my bargain hunting. I might, if the markets go down even further on Monday, I'm going to get some extra cash showing up. Plus, I might actually dip into my reserves from my Athabasca sale, which I actually have a lot of money in, because I might actually buy more of this AVGW. Again, it's down 7.5. If it actually goes down again another 2 or 3%, that would be interesting for me to actually consider buying into it. So that's going to be something I'm going to look at. So, all right. So that's that. Let's see what else I could talk about in here. So really, that's about it. So just generally in perspective, and that's about all I have to say, is that I wanted to have the new DIY investors realize that days like this could be very scary, especially if you've never gone through this before and you've seen your portfolio go down $2,000 or $500, but it's basically a big portion from what you thought. And then you realize you're not doing day trading here. As a passive income investor, you're basically buying these perennial income assets so that they will continue to grow your income. Don't worry about the NAV decline. It's unrealized NAV decline. It will come back up as long as you keep buying a good blend and you do a good diversification of core assets with some of the ultra yielders, if that's what you want, or if you're not even doing it. If you're doing all the core assets, which are, say, very conservative, 20% and lower, don't worry that your NAV has declined 1% or 3% or 4%. These things will happen. They'll go down, but generally speaking, they'll go up. Don't believe the naysayers, the ones that hate everything covered call, that tells you that covered call ETFs will erode to nothing, or when there's a major market decline or crash that's when your portfolio will collapse. It was too good to be true. It's not. Again, I showed you already on the graphs that the passive income portfolio will go down relatively about the same as any growth portfolio goes down. It'll go down the way the speed of the S&P or the NASDAQ, depending on which cover calls you have. And when those all start coming up, they'll go up. Now, the one thing you should know, because I don't want to think that I'm trying to BS you guys, if the markets go up really quickly, as opposed to going up gradually, you will get a NAV lag. It's called NAV lag, not NAV erosion, NAV lag. And the reason that's happening is because depending on which cover call you have, if it's written on 50% of your holdings or all of them, the things like the yield maxes are written on all of them. So you'll get a bigger significant NAV lag than you would if you were basically doing something like a Harvest or a Hamilton or an Evolve that's using only like 30 to 50% of their holdings, because they're only writing contracts on half of their underlyings. That means the other half is allowed to grow. But it will underperform on NAV recovery, because if it goes too quickly, then their contracts are hitting their strike price, and they can't go any higher than that. So that would leave the NAV behind the underlying's NAV. And again, I do have an entire video, and maybe I'm going to point it up here for those that didn't see that. It talks all about the difference between NAV erosion, NAV lag, and NAV growth. So as it's recovering, you might, depending on what your cover call is set up, you might get some NAV lag. But again, NAV lag is not a thing to really worry about as a passive income investor. You're worried about, and you should be always focusing on the basically trying to continue growing your income, compounding your income growth or maintaining your income growth by having more of these covered call ETFs. Keep filling up the bucket with more and more income. All right. So again, it will recover if you've done good diversification and you have a very healthy portfolio. Then your passive income portfolio will grow back. It will recover. Mine has, and mine's a pretty aggressive portfolio at 37 to 40% yield. And mine recovered from the April one, and I'm not worried about it recovering from the one that's happening right now. And I do anticipate, just so you know, my gut feel is that we're going to be entering into some rough times. We're at, I think we're near the top of the bubble. We'll see if that's true or not. But if that's the case, be ready for these NAV declines and these bad days. But remember, you will continually get your covered call income. It typically will drop down if, let's say, the NAV declined because of market conditions, say 10%. You should expect that your monthly income numbers will, on average, drop about 8 to 10 or 15% as well. So they'll be in the same range of the NAV decline. And then when it recovers, they'll go back up. Again, it's just a rough guess. But for example, when it happened with me in April, the markets dropped almost 15 to 18%. My NAV declined 15 to 18%. And my average income on those months, March and April, declined about 15 to 18%. And then if you could see, they all recovered. August was the largest monthly income I ever had at $53,000. So it's not something that once you lose it, you won't get back. It will recover on income just like it recovers on NAV. And again, ignore the fear mongers that tell you that this is basically sliding down the hill and it's returning your capital and you'll never see it again. Proof is actually in my portfolio as well as several other people's portfolio that does this, and that is just simply not true. So anyways, I hope this helps. Again, be calm. Take advantage of it. If you have passive income, if you have cash sitting on the side, take advantage of these declines. Look for a good deal that will fill in your portfolio properly and meet your target holding weights on whatever you have. And again, until next time, stay safe, stay investing, and I'm going to see you in the Pieverse.